enough. Hi, welcome. This is Pat O'Meara. I'm with Annelise Osbourne, and we're here talking about the tokenization of the private markets. And we are going to be spending an hour with Annelise Osbourne, who is an innovator. She's a speaker. She's a writer, all on blockchain topics. She's been in the space for a long time. One of the smartest people out there, really thinking about not only where we've been, where we are today, but where we're going. And we're going to spend a ton of time really digging into this movement from infancy to maybe the teen years. I don't know where we are in adolescence yet, right? But Annelise, thanks for joining me.
Pat, thank you so much for having me, and thank you for the flattery. It's very appreciated.
Absolutely. Annelise, tell us a little bit about yourself. But not only about, actually, let's start with the project you're working on right now. You're writing a book.
Okay. I'm writing a book. I guess leading up to writing the book, I started in the space in 2018, and we can get into that later. But my book is focused on from hoodies to suits. So it's really kind of the innovation growing up. It's innovating digital assets in traditional finance. So I've always been working on how do we upgrade finance and kind of make capital markets more efficient has been my push within blockchain. So we can kind of dive into the book in a bit, but the thought process is really, the hoodies come up with the innovation, but we're working with securities, money, value, and the suits are very important because I don't think finance is broken. I think that we can make it more efficient. It's been around for thousands of years, but it's hard to just have the innovators do that. I think you need the experience, the people that have been through markets, that structure deals, that work with regulators and recognize what can and can't be done, and kind of meeting in the middle, right? I feel like we're moving forward, and one point of that is, if you look at Mark Zuckerberg, right? Mark Zuckerberg was always known for his hoodies, but when he testified in front of Congress, he wore a suit. But that's a little bit different because that's Web 2, so that's information. We're dealing with value, but still, it's the idea of innovation growing up.
And we're going to talk a little bit about that information value dichotomy. What does that mean? What drove that? How is that transformational? I think most people on our in our audience understand that, but we're going to maybe touch on that for a little bit. But Annelise, tell me about your own background.
Okay. Pat wanted me. We were talking about the pictures behind me, which are the James Webb and the Hubble telescopes. I grew up in the Marshall Islands on a missile base. It was Kwajalein, Marshall Islands. It was 2.5 miles by half a mile, and it was really where they would test intercontinental ballistic missiles through Reagan and Star Wars. So it was a different world. It was definitely, I guess, the cutting edge where they would create missiles that shoot down missiles. We had bikes, no cars, so we went to school on a bike since I was little. There were 25 people in my graduating class. So it was very different. And then adjusting to coming back to the States. My father worked for MIT's think tank, so we would come back to the States often. But it was definitely a different place to grow up.
And so tell me, that led you into what kind of fields of study, and then what did you do professionally?
So I was always interested in finance because it had nothing to do with how I grew up. How I grew up was really rocket science. It was much more science-based. It was all PhDs. And so what it was interesting for me was, well, let's look at Wall Street. And it was also interesting, on a side note that we don't really need to get into, but where I grew up, the women didn't really work. And if they did work, they were teachers, because it was, I think, in the heavy sciences, there's very few women that would go on to get PhDs in these different levels of science. And so that was always interesting for me to think of, like, well, why can't I do it? How come my brother gets to do this and not me? And so that did propel me a little bit. And so I was really interested to go into finance, one, because it was different. It was kind of the studies of economies and money. And it was something different than I had already done, if that makes sense.
Absolutely. Absolutely. And so that is interesting. And if we have time, I want to hit on that in just a bit on the roles for gender. But let's keep going.
Yep.
So on the finance side, you got into finance. What did you do? And just give a quick run up, and then I'm going to hit kind of our first meetings. Yeah. Frank Volchek introduced us as we started talking in the early days when MakerDAO was getting set up, and you were working for Propeller, a broker dealer, and why don't we go from there?
Sure. So I did commercial real estate in Europe for 5 years, and then I came to business school. Real estate was interesting because it was different. It's interesting to value real estate buildings. They're not all the same. And then business school, I wanted to do more finance oriented. And it was really the beginning of CMBS and commercial mortgage-backed securities, which is a new way of financing. It decreases rates really because it decreases the risk. So banks can lend with a lower spread because you're transferring the bonds onto other institutional buyers that could buy at their risk level. And so that was interesting to me. I spent 12 years at Moody's, all different sorts of structures through the crisis in 2008. What's the right rating of a bond? What's the likelihood of default and recovery? So I really enjoyed that because it was very kind of both academic, but also, there was a lot of thought process that went behind of structuring what's the right rating. And then when I left Moody's, I did a lot of board work, and I was asked to join. I did a lot of entrepreneurial things there as well, helping to, like, after Dodd-Frank with regulation, doing some BP spying, working with some private equity and hedge funds, trying to start up new business lines or working to. I was asked to join the Cryptocurrency and Blockchain Regulatory Task Force, which was a group of young lawyers. And they were so energetic, and they called me all the time. And so finally, I figured it's learning something new. So let's sit down with them. And that's when I realized what blockchain was. That was more focused on ICOs and the need for regulation with different things that had gone on. But I recognized the benefit of blockchain and what it can do for finance. And so I assumed this was already being done. So this was not my problem. This is just what's happening behind the scenes. And then the more you dig into it, the more you find out that actually it's being done by entrepreneurs and tech people. And I think that was one of the issues. If we're going to create securities, digital asset securities, we really need to have people that have experience in financials and structuring to do that. And so I found my partner at the time who owned Propeller, and we worked together to create digital asset securities.
And so one of the things, when you think about this in the early days, right, there's a lot of people who are really captivated by the science. They're really captivated by the tech. They're really captivated by the cryptography. They're really captivated by whatever it might be that was their entry point. And that's the lens in which they saw the world, but not necessarily a securities lens, right? And how do we do this? And they're saying we can replicate it, but we'll do it over here. And the code is the law, and we don't need the law because it's all written in the code. And you go, not really, because sometimes the code breaks, and sometimes people violate or hack the code, and sometimes people violate the law. And the law is the law, and the code is the servant of the law, unless it's a private transaction between two people. But once you start to get many people in it, suddenly we need to have a basis to arbitrate disputes. And disputes will come up because unanticipated outcomes are going to develop, right? And this is, if we go all the way back to logic, right? And Plato called this, to have a logical argument, you need three things, right? You need a principle of identity, who's the other person I'm talking to, right? And can we name things? Principle of non-contradiction, a thing can't both be and not be at the same time, same place, same respect. That's kind of Satoshi with that. And then the third principle is the principle of the excluded middle, right? And the principle of the excluded middle is where people say, I want to have an argument, is it A or B? Well, somebody says, well, what about C? Well, we need to have a mechanism to exclude C, so we can just focus on A, B. And in the capital markets, that's bid ask. And somebody says, well, what happens if the foundation is bad? Well, we're going to rep and warranty that, or we're going to put that into a contract. So legal contracts are this principle of the excluded middle. What if this? What if this? What if this? What if this? And there's a whole body of law on, as we're dealing with not just digital instruments where there's no entropy, right, Bitcoin, but what happens if you're going to have a digital instrument representing a piece of the capital stack of an office building where there is entropy? Do you know what I mean? And then, or even a trust which holds a bunch of assets that you're surveilling. And I think this digital principle of the excluded middle, where you need to continue to surveil the asset and what happens to that asset or the neighborhood or the leases or whatever it might be, or this private equity asset, that the different pieces of the capital stack have all sorts of real consequences if something goes wrong. And we need a framework in order to process the real world that exists in a way that's not perfectly model. You can't perfectly model in an Excel spreadsheet, right? Think, when Genius fails, right? They didn't anticipate something and the traders did. This world that can, when I was in, so I spoke, I think it was 2015, I spoke at the Miami Bitcoin conference. Somebody shared the stage with me and we were talking about smart contracts and Ethereum and will this affect Bitcoin? And at that time they were calling color coins. And they were saying, what will happen with color coins? My co-speaker said, who I'd never met before, smart contracts will mean we don't need governments anymore. We don't need governments at all. And I was like, we're still going to need bridges, right? Like we're still going to need bridges to get over rivers, right? And we might still need armies, and we might still need the postal service. I don't know, but we still need a few things. And I think this is where the naivete, right, what you call the hoodies, right, meet the experience of I've done 10 of these, 2 went bad, or I've done 1,000 of these and 20 went bad, right? And how do you manage to the default, not to everything going perfectly, right? And I think this gets to exactly to in Moody's with surveilling the asset and continuing to give people marks. How do you manage and monitor that data when all of a sudden this thing's going to trade in a digital instrument, right? And I know I just went off on a little stump speech, but I want to get to, this was, I think, what drew you into and why the market needed you to be present, right?
Well, I look at technology as a tool, right? I don't think it has to be when we go to T+0, right? That means everything is done automatically, and there's not that buffer right now with T+2 where you still have 2 days to figure things out, right? When we have instantaneous and automatic settlement. So I think there are possibilities of issues when the trade is done immediately, but it's already been negotiated and decided on and then transacted. But I think that there are ways, we're still using traditional legal documents right now. I do think in time things will fade out, but I think there's also a process. We're looking at finance in the next 5, 10, 20 years, right? We're not looking at, this is not going to change tomorrow. So it's not going to be a whole bunch of uncomfortable people where technology is going to take over and we don't have jobs because we don't need to use our mental capacity to decide what works from a strategy perspective. So I really think that I agree with what you're saying. I just think that it's more like, I look at it a little bit differently, that it's more like we can use this as a tool going forward, as opposed to the scary concept that, it's totally disintermediated and I can't go back. Because I feel like some risk departments at some of the companies, because for this to be adopted from an institutional perspective, we're really dealing with risk and compliance, right?
That's exactly right. And how does the technology make the legal agreements that are needed to inform the performance of an asset that had to be built in a specific jurisdiction, that had to give a right of way for this reason? Do you know what I mean? And that right of way actually affected the capital stack. Do you know what I mean?
Yeah. Think about anything, anytime anything defaults, right? It goes into kind of from the master servicer where it all plays around into kind of sign a special servicer, or where you're always going to have that interaction. So I think digital assets can still go to a special servicer or some sort of situation where you're actually having, you're taking things off chain and figuring them out in events of default. But I think that is a smaller portion than what will be able to be transacted more seamlessly, especially when you're dealing with certain asset classes, right? If you're dealing with debt or kind of funds, or there's a lot of it that can be automated. But yes, I don't think we're getting rid of people.
I think that process of the administration of the complex asset and the waterfall of the capital stack that it took to get that asset built in this location, in this jurisdiction, with these building permits, right? One step at a time, and how that capital stack got there. That is the automation that can happen there is epic, right? And we got started in kind of the early stages, and Maker was just being created. And talk a little bit about that, right? Because you guys had a broker dealer that was going to deal in digital assets. Adoption didn't come fast enough with that particular entity, right? With Propeller. But you were working in the very earliest of days, right? Talk to us about that as Maker was being created. And I remember sitting in a conversation I think our third time we got together, and we were talking about the pros and cons. And did we buy the conference call that we had been on like the previous week, talking about Maker and what they were going to do and what were the obstacles and what they needed to have happen? Talk to us a little bit about that.
Sure. So when we kind of entered the space, it was 2018. We did do 3 different reg deals. So what we were trying to do was create really traditional deals done on chain. There's a cost to innovation. So this is kind of what we came across and had difficulties moving forward with. We wanted to bring real deals and tokenize them and offer them up to, these were all reg Ds that we did, so accredited investors. But when we would come down the line where we had this great deal, we were setting up, and we did a bit of debt and equity, right? But this one, for example, was debt. Well, when we priced it out, they could get cheaper financing somewhere else, so they went with a community bank in their town. So we went all the way down the road to do this great asset, and they found it. Because they found cheaper financing because everyone's a fiduciary, right? We're all dealing with money, so there's that additional cost or spread to actually have it as a digital asset and go out in a new form, right? So I think that was an issue. We did do 3 deals. So there's actually a fantastic Bloomberg video that was done on one of them back in 2018 on a property on the Lower East Side with just the thought process of deals going digital. But we did an A note. Did we do yeah, we did an A note, we did a mezz loan, and then we did a portfolio. And so to begin with, for the A note was a takeout loan, but the idea of having a 2 token structure, because you can actually, you can tokenize both the equity and the debt, even if the equity, if they don't trade the equity, right? But it gives them the option to trade out when this is something they had held longer than they had anticipated holding, because it was a construction project, right? So it benefits the equity. And then from the debt perspective, we tokenize the debt, and you can actually, there's a lot of benefits for tokenizing debt. For fixed income, you can have, generally the loan agreements are Excel spreadsheets, which are who pays when and conditionally, so that automatically can be paid out as smart securities. So you can also arbitrage, right? If they're both trading, you can figure out, and you can look at the dynamics. Is one trading below what I think it should be trading at? Well, then I'll buy it. Or if it's high price is higher, then you can sell. So we did that that was our first deal. Our second deal, actually, when you're talking about Maker, we wanted it paid in a stable coin. So we actually had, be interesting because I don't think this is happening today, but the idea was we did a mezz loan. So now we have a 3 token structure, right? Because you can technically see through, it's a peer through to see in the payment who's, have they paid, and you can get instantaneous payment information as opposed to waiting for 45 days to find out if a tenant has paid on any sort of, remittance report. And then you can actually tie it in with the A note to make sure that the A note understand the size of the A note and what the information is on the A note, and then on the equity. And that one we had actually payable in DAI. So that was the first time. We did not have many people that wanted to be paid in DAI, but we did have it paid in DAI. We worked with FINRA. We worked, it was a Reg D, so not as involved with the SEC, but it was super exciting. And then it was working on, if we wanted to get it approved, we had to get DAI on exchanges. If this was at that time, it was very early on that they could actually have set up the rails, right? A lot of interoperability is what we still would deal with today to make sure that you have, that you have the right parties and transactions, and you have the right, in this case, the right coins. So, stable coin, this is kind of also the beginning of stable coins. I know that they were around, but the thought process of that we really, for this to work, stablecoins are very important, right? For us to do anything in traditional finance, the idea of having programmable money, which is what is the representation of a stablecoin if it's tied at $1 that's not volatile like the other volatile currencies. So that was our second deal. And our third deal, which was right as things were kind of falling apart, is we had structured NFTs. So it was a portfolio of land in Texas, and they were all individual NFTs. So it's also to get people to think about, this was kind of a little before NFTs were so cool, but there's a lot of things we can use with them in finance. It doesn't have to be, NFT doesn't have to just be a reflection of art, but you can actually have them be representative of creating portfolios. But what we were also we were trying to create digital servicing. And we were trying to, we were just early. It was really hard to generate revenue. And we were merging with a fantastic company, Fluidity, who owned AirSwap. And so that was really interesting as well, because that was the hoodies. and we were the suits. And so we had an office in Williamsburg. So it was a wild ride.
It was, as a side note, I remember when that was happening, we were joking because they were all very cool and they all had to be wearing black, right? Do you remember your pictures on their website? And your picture, you were wearing color, and it was very.
Mine was changed. I had to have a black one.
Yes. Yeah, you had to wear. Yeah, you had to be. You had to be. And so, at that time, right? One of the reasons we were talking is, we had done these transactions. We did about $100 million of trades in 18. And the number of people who actually had done trades on chain of a security using Reg D was an extremely limited group, right? Mm-hmm. Like the number of people that were out there actually getting trades done. When we did the debt deal in February of 18, we did a mezz debt, and then we did some railroad cars, right? And we did this. And I think we were doing this, and this is one of the reasons we're talking back and forth, is because we're dealing with the same problems. We were trying to get something done. The number of people out there getting things done was limited. And I want to go to your NFT comment, right? Because NFTs are non-fungible tokens, right? And non-fungible tokens, I think how they are very interesting and how they're going to be used in the future, right? People go, we can create this NFT and we can split it. Non-fungible means you're not supposed to split it, right? Like I think it's the NFT in the future will be a trust, right? And Securrency has done some amazing things around how NFTs, you can have wallets inside of NFTs, and they can be mechanisms for trading pools or, in digital. We have some patents around digital SPVs, around how we use NFTs and smart contracts. But those are, what is a Series A, Series B, Series C, Series D, and the capital stack? How do those tokens, how do they all relate? How do we see the cash flow move between them? How do we prove the source of data, particularly when there's GDPR issues, one of the big things that Inveniam's working on, right? And I think there's so many different topics that you talked about that in the early days, we were saying, okay, we just got to get this done. We're going to put this, we got to deal with this later. We're going to put that on the board, but for now, we'll just do this. And it needs to eventually, we need to drill down and make that much deeper. But I want to just say, those were really cool, super innovating days. A lot of people were innovating. Stable coins have just taken off. Tokenized securities, we're still a ways away, right? We're not there. All the different elements that are there, people are leaning in. We're seeing tokenized assets. And earlier today, I was on a call with a Fortune 50 company where we were showing them a demo. They're overseas. We're showing them a demo of the integration of our platform and what they're doing. And they're using blockchain. And it's not instantaneous. It could be instantaneous, but they've decided to put a 15-second delay on every trade, right? Because they couldn't get to the point where it was instantaneous and atomic. Do you know what I mean? They said there has to be a mechanism for delay, and there's a 15-second delay in there. And it's interesting because it may not be T+3 or T+2, and T plus 15 seconds is a lot better than T plus 2 days, but they're still putting that non-atomic function in there, which is interesting because it gives permissioning capability. It gives all sorts of capability to layer function in for regulators in different jurisdictions to say, I'm going to live in that 15 seconds. Do you know what I mean? And I'm going to be able to automate that. And so it's fascinating. But these functions that are developing as we build this business, you've been here for a long time. You've seen a lot. Talk to me about what the institutional embrace of this looks like from your seat. Do you know what I mean? I have a particular seat that I sit in, but where is that embrace coming? Where is it going to start? Where is the biggest value, right? And who do you see kind of leaning in right now?
Sure. So, back when we did our deals, we're on a whiteboard and we have our legal, our compliance, and we're trying to build out these structures, and there's no one to ask because no one's done it before, right? So let's, moving forward from an institutional perspective, I think a lot of the asset managers are looking at how can we use this? The amount of press and research reports that are out there, there've been some great ones by Citi and Goldman and B of A. Binance even had one written on real world assets by one of their interns.
Yes.
That was well written. So I think there's a lot of big names out there in the space. So it's really hard to totally skip over what's happening. I think the banks really work in the payment processes, right? They're really more associated with money in and money out and are very highly regulated. So I don't know. Banks are great. I'm not sure that the most innovations are going to come from the banks. I think they're going to lead to what their customers are interested in, is what I hear from them for the most part. That said, there are banks that are innovating. And then the asset management side, I think the asset managers are the ones that actually, if we're looking, well, let's take a step two. Where will we see the changes? Like, where will we see these efficiencies built? So in public markets are efficient, right? So I think it's really more on the private market side that we will see efficiencies and see what's built out, and things that are less liquid than others, right? So what's liquid? Apple stock is liquid, right? You can trade it doesn't change the market price. But there's a lot of opportunities with different funds or private REITs or real estate property, whatever it is, that it's very difficult. There aren't opportunities now to actually trade in and out of investments, and that's where I think we'll start focusing. I also want to say, look at this next generation that's coming out. So I do have one of the chapters in my book is focused on the next generation, because I think it's important to look at, like, where is the money? Where is it going to go? What's the mentality of people coming? Because it's very different than, my stodgy mentality. Look at portfolios. Portfolios were 60-40 stocks and bonds. Nobody wants a 60-40 stock and bond portfolio now. Now, if you look at, there was a report done by BlackRock that looked at ultra high net worth. It's 60-40, but the 40 is alternatives. If you look at that money that's out there in the world, or in the US, like half of it is institutional and half of it is retail. That's a huge amount of retail money out there that we haven't really been, structuring deals for, right? And if all the asset managers want to grow, it's easier to grow from a low base, which would be trying to hit that retail sector. Now, where's the money? Right now, the baby boomers have most of the money, but it's transferring down to the millennials and the Gen Z, sorry. And the millennials and Gen Z
and Jay-Z.
Yeah, there you go. Millennials and Gen Z think very differently about how they invest. So they're much more, they're digitally native. They want everything on their phone, right? They walk around with a supercomputer. Most everything in their life can be done on their phone. Millennials are now hitting 40. They're the ones that are starting running departments and companies, right? They've always been inquisitive and hard workers. Gen Z has always been natively digital. They grew up with social media. They grew up with a different mentality of, look at what happened with GameStop. I don't think that's the first time that something like this would happen. I think they kind of voted with their feet wallets, however you want to look at it, and they actually believed in GameStop, but also we're looking at kind of going against the status quo with a little bit of Occupy Wall Street with, hedge fund that had shorted a lot of things. But they had done it online on a Reddit forum, right? They got together and then they all invested in GameStop. And looking at it, it was investigated by the SEC, right? Was this legally done? So I do not believe that anything illegal was found out there. But I think a lot of ways that Gen Z look at things is they are looking at, do I believe in this? So it's not all fundamentals. It's kind of in their head. And the other thing is, there was a study in the UK, 85% of Gen Z get their financial information from finfluencers, which are social media people. So all of this money is going to this group of people that think very differently. So I think our future of finance, when we're developing things like private markets and investing that retail money in different private opportunities, it makes total sense that you have large institutions like KKR and Hamilton Lane opening up private equity funds. Even Franklin Templeton has applied for a private equity fund tokenized that will have lower buy-in, so more people can actually access these opportunities.
Yeah, and when you think about where this is going,
Mm-hmm.
just to add something to what you're saying, I always give an example of my son, right? Who his paycheck gets deposited to a bank, but it's instantly swept to two places, Coinbase and Robinhood. That's where all of his money sits, right? And he maintains a zero balance at his bank at all times, because why would he keep money there, right? Like, why would I keep money there? And his ability to move things in and out and instantaneously move it to his bank and connect a payment card, et cetera. And all of a sudden you start to go, what is store of value, right? What does custody mean? And a token that I can have liquidity on that owns a piece of a real estate portfolio, the equity, the mezz, right? Or the senior, right? Or an interval fund where I can attach that to a credit card. And if I can sweep my checking account directly into that, and I have liquidity 24/7, 365, and it's connected to a MasterCard, and I can use that to buy my latte. Explain to me the role of a bank again, right? Like all of a sudden, like the changing nature of what is a bank. How do we store value? What is the locus, or where do we store value? And then how do we allow many people to participate? And the reality is, we're talking about information. Who has the most access to deliver information? And we're talking to some senior executives, and they were talking about, they measure who they can still push information to real time on their phone that people will actually listen to and pay attention to. And the number, because a lot of people, you turn off your notifications, right? For Chase, my notifications are off, right? What are the notifications, or my Citizens Bank, or my Bank of Ann Arbor, right? Whatever it is, those are off. Robinhood and Coinbase have the most people that they can touch with notifications and push information to real time. Isn't that interesting? Out of anybody.
It is, and I don't remember the numbers now, but the number of times people look at their Robinhood account is astronomical per day. It's like the average user looks at it 5 times a day, or something of the like. They'll quote me on that number, but it's a lot more than you would think. I don't check my bank account every day, but everyone's, the number of, most of the Robinhood users are under 30, I think.
But all of a sudden we have a whole new type of company that owns the frontal lobe as it relates to finance of an entire generation. And other people are going to say, how do I need to get in that frontal lobe? And one way is you can hire a Kardashian, right? The other way is to say, how do I deliver functionality to a phone? You know what I mean? Like, I know that, I'm sorry, that may not be in your book, that as a marketing strategy, but literally when we say, how do we get into that younger generation? And I think that this functionality, blockchain brings that atomic settlement. It gets the ability to have that observability where I'm not trusting a brand, but I'm trusting computation and my ability to observe the source of the data. What is the oracle? Yeah. Let me see the transaction. Let me make sure that the balance is foot. And it is the trust in the cryptography and the code for that digitally native generation, right? And I think that it's going to be transformational to banks if they don't get there.
Well, this is really kind of in the RIA world, right? So it's not even just this generation, but it's also like the large ultra high net worth and family office. Everyone's looking for kind of more the alternative world. Fewer companies are going public now as well. So, I think the real opportunities, or the opportunities that people are looking for, are outside of that. I think there's a lot and transferability. This is another thing. So if I want to invest in a project, say, well, what if I don't want to hold it for 5 to 7 years, right? What if my world changes and I want to trade out in 3 years? And so if it's a digital asset, you have an option to actually trade, right? You're given that. And I would pay for that optionality.
Or for a developer where they're saying, I've got a capital stack with 7 different pieces of the capital stack, and I'm going to pay a little bit more money for this piece of the capital stack for it to be for somebody to help maintain liquidity, because that helps price the rest of the capital stack, which may only trade once a year, or twice a year, or once a quarter, whatever it might be. But that incremental liquidity means the entirety of the capital stack is lower, right? And all of a sudden, that's where you get people like Cushman & Wakefield, they're an investor in us, pushing into digital, saying, I understand that a reference point within the capital stack can be used as a mechanism to impute the value of the entire capital stack. And this gets really exciting when we think about where the whole market's going to go.
Which is really, we haven't used the word data very much here, but this is all data driven, right? And then so that's the thought process of anything that's digital, we will have much more data in it, right? We will be able to understand trades better. We're going to be able to repurpose that data in different ways. But I think it makes a lot of sense to have that. So not everybody wants markets that are totally open and transparent, right? I think a lot of people had made money off of the fact that not everyone has equal access to information. But the world is changing as well. Like look at the internet, look at encyclopedias, right? Like we can look at Kodak film, look at all these things that are, people didn't keep up with the times, right?
Yep.
And now we have more access to information.
and it's going to be demanded, and people are going to expect it, and we need to do that. And it's not going to come from one central repository. We're going to be pulling data from the edge, and if we're going to trust that data, the people at the edge who want you to buy their asset are going to need to be able to not only credential their data and push it into financial instruments or compute on demand in order to continue to feed the data stream, but they're going to need to do it in a GDPR compliant manner, right? And that's the Inveniam role. But how do we push data? It's not going to be in a central repository. It's going to be from the edge, and it's going to be being delivered into these digital instruments. And let me ask a question, Annelise. Where will those digital instruments live? Public chains or private chains?
You had asked about kind of what's happening, who's interested, are institutions paying attention? Institutions are definitely paying attention. Right now, I think there's questions about being on public chains. I think there's concerns for security and privacy information. That said, there are permissions that you can put in place. There are zero knowledge proofs, I think, will be wonderful for the industry as well. So I think a lot of people are turning right now to private chains. A lot of people are creating their own private chains. A lot of, when I say people, I mean companies. And so I think that is beneficial with the idea of they're getting used to blockchain. I think it is not so great because there's a huge interoperability problem when everyone creates their own chain and then they're private, and then you can't actually open it up to an ecosystem. So there's not kind of trading between, but everyone has their own little walled gardens. So I'm a big believer in the permissioned public chains, but it might take a while to get there, right? So I feel like we need people want to work with something that they're familiar with as well. So names that they recognize. Like this is one of the issues with startups, I think. If you go to, we're all fiduciaries. I want to put my money in a company that's been around for a while. So if I'm going to invest in a digital money market fund, for example, Franklin Templeton has a digital money market fund, right? Wisdom Tree has one. Ondo is there. Arca Labs, we had the U.S. Treasury Fund. But I feel like people want to, and companies and compliance and risk officers want to both work with in custody, for example, because custody I think is going to be an issue as well. But part of this, from a public-private perspective, I think there's a lot of things that tie together because regulation touches that too. Because regulation is one of the reasons everybody's private right now too, and people are concerned that if why would we create something that then we're against regulation? Because again, this is where the suits come in. This is where you need the experience, and we need to make sure that we're protecting everyone's best interests. And so that's why I think the easier step right now is some of the private chains. I know there's also such a huge push for interoperability, and interoperability means different things, but one is just that blockchains can talk to each other. There's been problems with bridges and hacking in the past. So there's a lot to work out there, but I will say that yes, institutions are paying attention. They're generally working with private chains right now. I think there's some great options and innovations that are coming out. So it's really difficult for large companies to innovate. I feel like you really need kind of the hood work, and we're calling them hoodies, whether you're hoodies or not, right? It's just that different mentality of coming up with ideas while you're not you're not in a corporate environment where you have meetings all the time and reports and what have you. I also think it helps if you don't have, if you look at the structure, the pay structure of a lot of corporate American finance, for sure, if you're a public company, you're reporting quarterly on your share price. And if you are, if I'm running a group and I get paid my bonus, why do I want to? I kind of, if I do a good job, I'll get my bonus. If I try something new that doesn't work, I'm probably not going to get my full bonus. And so it's almost like disincentivized for me as a person to step up and put my neck out. And then also kind of from a public company perspective, there's that cost to innovation. And do you want a large expense to go with something that might not work? So I feel like a lot of the innovations, it's easier to happen at a startup and then kind of get absorbed.
Yeah, and it really is. And there's so many great books on innovation and how you do it in small corporations, large corporations. And 3M is a beautiful example, right, of somebody who refound their innovative spirit, right? And what did that do to their financial earnings? And how do you create this? And I think one of the issues that we have in the regulators is regulators in different jurisdictions are seeking to achieve different outcomes, right? Some are trying to attract innovators in order to, and give them an environment to act as a good actor in a regulated environment, right? So Inveniam opened an office in 2017 in Gibraltar because they were going to regulate, right? And we needed a place to be a good actor, right? A known good actor innovating for securities. But this reality is there's other ways in which regulation, in some ways, can protect the incumbents, right? And the burden of regulation can depress innovation. And this is one of the things that you're seeing on Capitol Hill today, where people are saying innovators are fleeing the U.S. and they're going to other parts of the world. The Ripple case, I think, changed a lot of that sentiment. But talk to me about this, and I'm not asking you to opine on regulators in one jurisdiction versus the other, but what role does jurisdiction have in this innovation moment for what's going to be critical infrastructure and where that critical infrastructure is going to sit globally?
Sure. I will first say that the United States of America is a superpower, and that I think we are in it for the long game. So I do think that we will figure out smart regulation. We have to be careful not to over-regulate something that is an innovation, because we don't necessarily know what the next chapter looks like, as much as you and I can project and say, this is where I think we're going to go. And see, rails that might make sense. So I think that is one thing I want to say within the U.S. And I do think regulators are interested in trying to learn. And we have had some foibles along the way that kind of set people back, because the whole blockchain, not Bitcoin, we still have to educate on. So I want to say that within the U.S. I do think there's a lot of pockets of innovation. If you look at, there's a lot of digital bonds, and I'm a huge fan of blockchain for debt, being done out of Europe, but they're generally being done out of, I believe, Switzerland. There's 3 places.
Germany, yeah, Germany has great regulation on this, right?
Yeah, and then I think and then somewhere out east. So I do think there's going to be pockets of innovation for sure that are developed, and I think we can also learn from what regulators are doing at other places to figure out what works, and that we could potentially incorporate ourselves, with ourselves being within the U.S. Only because I'm more focused on the U.S. right now, and my book is definitely focused on the U.S. But there are obviously a lot of pockets of innovation. I think there's a lot going on in South America. There's a big push to do digital assets as well, and real world assets, and a lot on the crypto side. So I think that that's what you need, is you need the change makers that want to do the projects, right? That have the money, that are the institutional side, that want to do the projects. Because I'm a big believer that this has got to be institutional as well. It's not going to go from the bottom up. It's really going to kind of come from the top down. I think different ways are going to, like, different programs are going to start off stronger than others. I think Figure's done a great job with creating digital HELOC loans, right? Being fully on chain. I think JP Morgan has done an outstanding job of creating something internally that benefits them tremendously. It's difficult to go outside of JP Morgan now, because it's all internal to JP Morgan. But I do think there are pockets of innovation that we've figured out, and those are both US based. But I also think externally, and from a regulatory perspective, we could learn from what's been done. And absolutely, there'll be different pockets where it'll be easier to transact.
Yeah, and I think I would cite HQLAX as another innovation moment on repos that's just really killing it. Maybe Luxembourg was the other entity, or the other location you were looking for. Unfortunately, I got an email. I have to drop 15 minutes early, so we've got 2 minutes left. I'm sorry that we're doing this, but I'm living in the real world where I'm also running a business, so I apologize about that. But I'd like to throw this out if anybody else has any real quick questions. But Annelise, I'm sorry that we're doing this after 45 minutes, not an hour. It's all my fault. But tell me, you've got the last 2 minutes. Where are we going to go? Where are we going to go?
Where are we going to go? Kind of, you got the short term and the long term. The short term, I think there's going to be a lot of programs that are developed. So not just proof of concepts. You're not going to recognize the cost savings that you will, and the efficiencies on just the proof of concept. So I think our people are starting to create programs. As in repeated projects. And I think kind of as we go a lot further out, I think we're going to see a lot of convergence between DeFi and traditional finance. And DeFi being, there's a lot of things that they've developed in the crypto world that actually can be transferable, even though there's, we use different words. So I think language can be a barrier at sometimes, but there's a lot of programs that we can move out. And my book is From Hoodies to Suits. It's coming out next year. And I am more than happy to talk about it next year, because I have to pre-sell a bunch of books. So I hope you guys read it.
Yeah, everybody, please order this book. Annelise, what a pleasure to be with you. You're always, it's great to engage with you. Your depth of knowledge is fantastic. I'm looking forward. Let's do it again. Let's do it again also, where we invite some other people on, where you and I can tag team and beat people with a stick together. Right. And and put them in a corner where they have to make hard statements, right or left, right? But what a pleasure to be with you. Thanks so much. And we'll be posting this down the road.
Thank you so much. I appreciate it.
Thanks.
Pat, bye.